All right. Welcome, ladies and gentlemen, and welcome to the beginning of the week technical and fundamental analysis. I'm about to go ahead and jump into it. Before I jump into it, let me give a quick disclaimer. This is not financial advice. Anything that we share during our analysis is for educational purposes only. I repeat, this is not financial advice. Anything that we share during our analysis is for educational purposes only. Cool beans? Cool beans. So, looking back over my technical pre-week analysis yesterday, um, I told you guys that I did not want to see us close above consequent encroachment of this um, daily wick right here from Friday's price action because my bias is bearish for the dollar. So, but I did tell you I would allow for us to pull up and run that daily buy side liquidity as long as we did not close above it, right? So I told you guys if we did break above and close above consequent encroachment, that I expected price to run the buy side liquidity from November the 24th, right? So we got that ring and price closed below the 62% of that candle's premium PD array, right? So going forward, I am still bearish dollar, right? As I said yesterday, the only way my bias will switch to bullish to see us run the weekly buy side liquidity and possibly run back up into this inverse daily volume imbalance is if we if we break and close above the daily buy side liquidity, and we haven't seen that done yet. So until that happens, I will remain bearish. Now, what I would like to see going forward throughout the rest of the night is us respect consequent encroachment of this fair value gap and respect the 62% of the daily PD array, right? And I would like to see us respect that throughout the rest of Asian markets and London markets tomorrow. If we get that, I will be bearish for the dollar tomorrow to at least come back down into the discount PD arrays from today's price action. Easy peasy, easy peasy. So looking at currencies, I told you guys that I was bullish. Of course, we're inverse with the dollar when it comes to currencies, meaning we move in the opposite direction. I told you guys that as long as we did not close below Friday's sell side liquidity, right? I would remain bullish and I expect us to pull back up into Thursday's premium PD array levels, right? These levels right here. So that still remains. And the only way that reverses is if we break and close, break aggressively below Thursday, well, today's low now and close below it, right? Then I have price coming down into this BISI, aka fair value gap, in weekly PD array levels. So that remains intact for now. So I'll be paying attention to price throughout Asian and London and see what the market is looking like pre New York opening markets in the morning. Same thing for GBP USD. I would have rather see us hold above consequent encroachment of this fair value gap, right? But I told you that I would allow for price to pull down into the 79%, right? And I told you the only way my bias would flip to bearish is if we ran the weekly sell side liquidity, broke below it aggressively and closed below it. And we see we just ran it and we closed above or right on that 79% PD array level. So I am expecting price to correct up into today's premium PD array level. That's these two levels here. And I would like to see us break through those levels with aggression, right? Aggressively, and then find support when we come back down to retest them after we break through and continue to the upside. So that my bullish bias still remains the same for currencies across the board. Um, that's with NZD, USD as well. So as long as we don't break below the daily sell side liquidity and close below it for NZD, USD, I will remain on the buyer side for price to run up into this fair value gap that you see here, running this buy side liquidity that you see here. So that's what I'm expecting out of currencies moving forward. So I'm just on the sidelines right now. Had a lot going on with Trade Locker today. Trade Locker is, if you're using Trade Locker, be careful. They got some crazy mess going on over there. I would say just wait until they get the platform, all the buzz and the all the kinks out. This new platform that KOT is that they transitioned to. So they got some crazy mess going on over there. But yeah, so I was in a trade this morning with them and my stop losses got removed, take profit got removed and everything. So there's a lot of people in the Discord complaining about the issues, a lot more issues going on. So reached out to them. They looking into the situation, but they haven't resolved it yet. So we'll see. So won't be trading in them for a while. I'll be sticking to Ninja Trader and Trade of 8 until they get their issues. Yes, I'll be taking my money out as well and putting it in TradingView and Trade of 8. So that's that. Moving on to futures. Sorry about that. Moving on to futures. As you can see, my overall bias for futures this week is bullish, of course. But I told you, as you can see, as how I had it drawn out yesterday on the pre-week analysis, I did expect the market to open up bearish today, right? But I wanted to see the markets buy from 62% PD array level, as I have drawn out here. And we pushed through it, right? Rant Fridays buy side, sell side liquidity, Rant Fridays, sell side liquidity. But you can see our daily candle closed right above the 79% PD array level. Now, this is a 5-minute inversion fair value gap that you see I have marked here. I want to see us hold the consequent encroachment of that 5-minute inversion fair value gap. We're currently right below it, but ultimately, I would just like to see us respect the inversion fair value gap, right? I would have loved to see us hold above it, not break and close below it. But I want to see us get back above, see if we can respect this inversion fair value gap, get back above the 79% and 62% daily PD array and continue to the upside. So for now, my bias do remain bullish for futures. And the only way it will flip to bearish is, as I said yesterday, is if we close below the daily sell side liquidity. And then I would have us coming down into those weekly PD array levels and possibly this big imbalance that we see here from November 14th. So that's what I'm looking at for ES in ENQ as well. Yeah, we got that pull. Well, yesterday when I gave the pre-week analysis, we was right here at this 79% PD array level. I would have liked to see us go up from there, but as you can see, we came down, as I said in the pre-week analysis, if we broke and closed below the 62 and 79% weekly PD array levels, then I told you guys that I seen price coming down inside of this imbalance, aka BSC buy side imbalance, sell side inefficiency, particularly to this blue shaded area right here, which is the 50 and 30% Fibonacci level of the gap in this BSC, right? So basically the gap of this fair value gap, Fibonacci that in this shaded area is the 50 to 30% of that, right? So let me just show you right quick. Boom, 50, 30%. And I'm sorry, um 70 and 50 and 70%. I said 50 and 30%, but it's 50 and 70%, right? 50%, 70% PD array level of this inverting fair value gap. So that's what that level is. That's why I had this shaded area there. And I told you guys if we broke and closed below the 79% weekly PD arrays that I had price running this sell side liquidity and coming down into this shaded area here. Came down, kissed it perfectly, and then backed up off of it. We did close below the daily sell side liquidity, but not the weekly. So yeah. I would like to see how price plays out throughout the rest of tonight, going into um, the London markets. Um, yeah, we could be going lower. Um, so yeah, let's just see how price plays out throughout the rest of Asian and London in the morning, guys. So that will conclude the beginning of the week technical analysis. At this time, I'll go ahead and pass it over to Corman so she can give us the saucy fundamentals. It's all yours, Corman.
Well, hey everybody. So tonight I am going to talk about a couple of things that have nothing to do with the mind, the brain, the Forex Factory calendar, although you could relate it back to the Forex Factory calendar if you wanted to. And I'm doing this now because I feel like there are a couple of things that are going on warrant this, and also for the fact that um this is around the time that I told you guys that I would be telling you what my thought process would be for 2024. While this isn't all of it, this is some of what my thought process is. Um so it's easy for people to give a thought process behind what they feel like next year might be like in July, in August, in October. Some people even do it like late November. However, to me, the way that you have to look at economics and you have to look at global economies, you have to look at them as a whole. And you can't just be focused on one thing because that one thing has so many different things that impact it. So if anybody in particular was just looking at inflation and the only thing they looked at was inflation and the only thing they set their bias upon was inflation, is flawed because inflation is a factor that can be mitigated and it can change based on market conditions. So first up is the Fed. So a couple of months ago, the Fed started alluding to the fact that um they probably were not going to hike, and if they did, it would probably be the last one in 2023, and then we could potentially see rates plateau or even drop in 2024. And then now the more quote unquote stable, if you want to call them that, that the numbers get, the Fed is now like, okay, well, um, in a way, if things stay the way they are and things continue to move the way that they are, like, yeah, we'll cut rates. Um, I really encourage you guys to go back and look at what happens when the Fed goes from low rates to high rates and back down to low rates, and they cut rates before problems are actually solved in the actual economy. So as you um can you mute your mic? I'm echoing.
Oh, my bad. One
Okay.
sec. 1 second. Oh,
So um when the Fed is talking about changing rates that fast, you have to actually go back and see what happened in the past when the Fed did those things. So the market doesn't always adjust as quickly. Sometimes there are areas of the economy that aren't quite as strong as the numbers might make them out to be. And then whenever rates change, those areas of the market start to show their cracks, and then pressures from other areas of the market just cause those areas to falter. So, if I just had to look at any areas in particular right now, um, housing, while yes, rates are high, um, you'll end up having a lot of people upside down. Um, while yes, I know there are lots of people who are like, I want a house regardless. I want to get a house because they were, this will sound kind of bad, but they were pressured into buying a house because they had an agent or they had a friend or they had someone who they trusted who said, there's not a lot of supply. You should buy now if you really want a house, blah, blah, blah. And they bought a house and rates are 8%. And then let's say the Fed does cut rates next year, not just once or twice or three times, but let's say they cut them all the way back down to zero. Um, Now you got a mortgage with an 8% interest rate. And I know all those people that will be like, yeah, you can refinance, you can do this or that. Do you understand what happens when you refinance or consolidate debt? It's not only that debt that you wrap up, but you also wrap up other assets into that. That's why, like, side note, you have to be careful if you do like debt consolidation with like credit cards and loans and stuff, because not only is it that credit card debt that's going to be wrapped up, it's also going to be the value, or not even the value, but it's also going to be other assets. So you could possibly end up wrapping your house up into that. So let's say you don't make a payment after you reconsolidate your credit card debt, your house could be taken from you and used to pay that debt and then sold and then go through that whole process. Anyway, um, but you have to look at the areas of the market. So real estate, um, other areas currently, banking, banking doesn't really show cracks like people would think. The banking or in the financial markets, when they are struggling, you actually see banking entities get bigger. So you think, oh, that bank is growing. No, that bank is just taking over certain markets, or they did a quiet merger, which happens, and you'll never really know until you see a Bank of America become a Wells Fargo, or you see a Fifth Third Bank become a Truist or whatever. It's not until you see those things happen, and yeah, there are certain disclosures that have to happen because of the financial aspects of the market, but sometimes those mergers can happen and those individual entities are allowed to keep their own name. It's almost like the merger that happened between Harris Teeter and Kroger. Um, it's all oh wait, I'm about to mess it up. Anyway, the parent company, the parent company and the subsidiaries, they still keep their branding. Um, but it's all one company. So it's like it's things like that that you have to take into consideration and think about. So banking, real estate, retail, um, the retail market, you'll find that a lot of stores now, when they come out with their earnings, you'll hear it a lot in January. So not necessarily January per se, but like the earnings season that starts in January. Um, you'll hear it a lot. Companies will come out and say, um, they'll talk about their theft, and they'll talk about you know, all of the measures that they've taken, even to the point where Walmart has considered getting rid of self-checkouts because of their theft issue that they're having. So people are like, "Oh, well, good. Now you're going to bring back the cashiers." Um, knowing Walmart, that might be something that they do. However, if you ever get a chance to venture to their headquarters and their flagship store, you'll see self-checkouts and um I'm laughing because of something I'm getting ready to tell you that relates back to our last class. But self-checkouts and cashiers and stuff like that, like it that store makes self-checkout look like the cashier. Like, who needs that anymore? So remember in our last class when I was talking to you guys and I was like, yeah, it's going to get to a point where, you're going to have something. I'm just going to say something now because it could be anything, but you got to have I'll just say it, like a social credit score. You got to have a particular social credit score to get into a store. Well, it's almost like think about the Amazon stores. I don't know if there are any on the East Coast. And if they are, maybe New York, maybe. But anyway, you got to have an Amazon account to get in. And you scan to go in, you get a cart or a basket, everything that goes in gets tallied, and you just walk out. Walmart has that same technology. So when people are like, oh yeah, theft problem, bring back the cashiers. What? No, that's expensive. What are you talking about? No, no way. It is much easier to head in the direction of digital technology and just continue down that path and not bring back cashiers. People are expensive. You have to train people, you have to pay people, you have to pay people benefits, not only for them, but for their families. You have to pay for them to have time off if they get sick. You have to pay to replace them. You have to give them bonuses and incentivize them. You have to reimburse for uniforms. Yeah. Companies will like list all of these things. And yeah, some of those things are tax write offs for a retail company. But whenever you start to talk about loss prevention and you start to talk about theft, and you start to talk about just the fact that these companies are losing billions and billions of dollars, a lot of retail stores are moving out of particular certain areas to help cut costs. And some retailers have said that starting in 2024, not the beginning, but maybe second or third quarter, they're going to start moving most of their sales online to help prevent that even further. So, if you've gone into a Best Buy, and I don't know if Best Buy does this a lot compared, comparatively, but there are some stores that only keep models and display versions of whatever it is you want to buy. Then you order it online, in the store, over the phone, however, and then you go in and pick it up. And you have a designated time that you have to pick it up. So retail, banking, real estate are those three areas where I'm looking if rates do start to drop, um, and there's pressure being put on the markets. I would definitely be looking at those areas, because it's a couple other things. It's kind of layered. It's like an onion with those topics. So with um, real estate and with retail and with banking in particular. So we've been in this period of high inflation. There is a transition period between any inflation point, either the beginning or the end of it. And you can't even really say the end of it, but you can say like the end of high inflation. So at the beginning, there's a pain point because prices are shooting up really fast. People's pay isn't really matching the pricing, and it's like, oh my gosh, can't really cope. So companies change like halfway between the beginning and the peak of inflation. Companies shift, and you get what starts shrinkflation, which is where you pay $2 for 2 ounces of chips, and then you're going to pay, um, let's say, $1.50, but you're only going to get an ounce of chips. So yes, they cut the price to $1.50, but they also cut the packaging size and they cut it in half. So it gives you the illusion that you are paying less for an item, but in reality, you're actually getting less, and considerably less if you did the math by units per cents. So corporations do that. Then you hit peak inflation. Peak inflation, people feel like, okay, pain point. For some retailers, they don't start shrinkflation until this point in time. The majority of them is somewhere in between because they're trying to get ahead of what might be pressure points before the consumers completely fall out of the market. You hit peak inflation, and then by that time, people have either lost their job, employers have decided to increase salaries to help match, and make salaries more market competitive or acceptable. Or there's some type of benefit program provided or sponsored by the government that helps to bridge that gap. Then, once you hit peak inflation and you start to go downhill on the other side, that's where it gets very, very tricky. And while inflation may have plateaued and even dropped slightly, that doesn't necessarily mean you can drop rates to zero, because between high inflation going back down to a more normal level, considering what it was before peak inflation, there is a pain point. That pain point isn't on the consumer anymore. The pain point is on corporations and banks. Why? Because corporations, the retailers, they have these high prices, and um, they are paying employees more. And now it's like, okay, now we're dealing with these shifts in rates. The expectation is that when you hear in the news that inflation is coming down, people expect pricing to be reflective of that in the store. So stores have to now find a way to help bring down pricing. So it's either you make your consumer upset or you make your shareholders upset. Shareholders pull out, you have really big problems. For the banking side, you now have loans that were given out at very high interest rates, which is why banks typically don't give out a lot of loans when rates are high. Interest sorry, when inflation's high, when loaning conditions are tight, because you could possibly end up in an upside down situation. The consumer could, but they'll come back to you to bridge the gap. And you're losing money on that side. But then also, for consumer accounts, when interest rates are going up, deposit rates go up. So most deposit rates right now are somewhere between like 4 and 6%. Interest rates go down. Theoretically, they will bring rates down, which is why you see a lot of people transitioning money out of stocks and putting them into treasuries. Because treasuries right now, if you buy a treasury, you can lock in like a 5.35 or something like that percent interest rate. So if they do cut interest rates, then which is very likely, you will have that rate locked in, because rates are going to start falling in the treasuries, which means that banks are going to start lowering their rates, which means that people aren't going to be quite as likely to keep their money in the bank. Because now it's like, well, I'm back down to 0.25% on my savings account. Why do I want to keep my money here? You lock it in while rates are high. So the goal is to always have enough money so that whenever rates go up, you have money to shift into stable assets so that your money holds its value, and you can lock in a treasury. I mean, like, there are certain bonds you can get, and you don't even necessarily have to hold them out to 30 years. If you close them out early, you just forfeit the last 3 months of interest, and that's it. So you get it and you just hold it, and you can hold them for up to like 30 years. So that's just money that's just locked at that one interest rate. Interest rate go higher than that. Okay, cool. Roll it over into something else. But at least you know that if the Fed decides to cut rates, you've locked in that rate. So no one can say, oh, well, you know, your money is making less than inflation, or whatever the case may be. So those are the things I kind of think about whenever it comes to like how could cracks start to form for the banking system. The banking system is already struggling. You already have people that can't meet their debt obligations. Um, and you have banks that are having to find other ways to help mitigate the risk of people not being able to meet their obligations. Now you add to the fact that the Fed could possibly lower rates, which, yes, it makes money cheap for banks, but we're not talking about cheap money. We're talking about the penny on the dollar. I mean, the penny for penny money that the banks have been getting for this last couple of years or so. Like, money is expensive for them, so to say. It's not going to be that way anymore. Um, so when you have consumers pulling out of your banks, you're losing money. That means you can't lend like you want to. You don't have that revenue stream to just be able to go and request of money from either your peers or the Fed like you want to. I explained the retail side, and I kind of briefly explained the real estate side earlier. So, yeah, those would be the areas that I would look for to see cracks. Areas that I would look for strength and growth, or just like, I don't want to say safety, because safety is just, it sounds like it's nice and safe and it's cool and nothing will happen in that area of the market. But it's where things are less crazy. So that would be defense. Consumer staples, because there are certain things, consumer discretionary spending and consumer staples. Between those two, consumer staples for me will always win out between the two. Staples and just versus discretionary. So staples, things you have to have, like you can't go without them. Food items, cleaning items, um, hygiene items, all fit into that category. So whether it's chips, so I'll just name some companies, whether it's Coca-Cola, Kimberly Clark, Clorox, P&G, Johnson and Johnson. Actually, let me back up a little bit because Johnson and Johnson, um, this is another reason why we're getting ready to go into a crazy environment. This is a hint here. There are two major conglomerates that split recently. Johnson and Johnson and Kellogg recently split their companies. So like these were huge conglomerates. So Johnson and Johnson split its medical devices side of the business away from its away from like its baby product side, baby products, hygiene, like all the beauty care, health and wellness stuff. So they split that part of their business. Kellogg actually Kellogg split the snacks and the cereal. So cereal is like its own thing now. It's Kellogg, and then I think the other side of the business is like WG Kellogg or something like that. Um, anyway, Johnson and Johnson's other company, they just split into, it starts with a K, and it's not really coming to my mind right now. But anyway, all of them are still publicly traded entities, but they just split the business. So when times are hard, companies are always looking for a way to split off businesses. Why? Because if you have a part of your business that is super profitable and you have another part of your business that is not quite as profitable, what you can, or you have two sides of your business where they can benefit from taxes different, you split them off. So you take this side and you say, look, this is just going to be the profitable side of the business. We're going to find our way, or we have a way, or it's always been the way that we've treated taxes and blah, blah, blah with this side. This side, not so great. So we're just going to take a loss, but we're going to write it off and we're going to roll that loss over into this side because technically it's one business and typically it's your umbrella that's doing the whole structure of how all that works. Anyway, your big business will sometimes do the overall conglomeraterized taxes. Oh my goodness. For all of them, or depending on how you're structured, each individual business will do its own taxes, but all the accounting gets done at the top. Needless to say, they have people that sit there and just read the tax code and they just know, like, okay, look, this interest rates are high. This side of the business is not doing well. So we need to find a way to mitigate that risk. How do you mitigate the risk? Split it off. Period, point blank. You do that. Also, to me, in my opinion, cereal is dying. While cereal might be that food that you can go to, when you're hungry any time of the day. Wheat is expensive, processing is expensive, trucking it across the country is very expensive. Water is expensive. Farmland right now is expensive. For reasons I'll just have to explain later. And then also, if you notice, shrinkflation happens most in packaged foods. So if you can package something and put it in another container, or if you can package something and put air inside of that packaging, then you can hide how you're able to overcome inflation. So cereal is the main culprit. You'll have a big box. You think you're getting all this cereal. You'll shake the box. You hear all this cereal. The louder the cereal box, the higher the shrinkflation, because you're really not supposed to hear cereal like that shaking in the box. If anything, you're supposed to hear the bag sliding. Anyway, so cereal's the main culprit. They split cereal off. I feel like the cereal business is really struggling and they will try any way possible right now to get the cereal business to stay afloat. But anyway, back to what I was saying. Consumer staples, defense, and crypto. Didn't really talk a whole lot about crypto. I will say now though, I want you to think about something and keep this in mind. If the market is performing like this, which is for the most part, the market's performing well, look at where rates are. Look at current market conditions and look at what's going on around the world. All the things that could have the market like tumble. Market's like resilient right now. It's like nothing. Don't say that. Um, let's see. How can I reword what I was going to say? Um, there are lots of things that could have the market looking in another direction, but it's where it is today. Imagine what markets would look like when rates are lower. So if you don't remember the economics of how markets function versus rates and such, I will explain them now. The market tends to thrive. So think about early 2000s when you had like right after the dot-com bubble, rates were low. Actually, no, that's not. Let's bring it even more recent. After the housing crisis, when rates were low, you know how many startups you had? Think of the thousands of startups, crypto included, that you had after the housing crisis. Rates were rock bottom. You could go and get money anywhere. They were just trying to stimulate the economy. They had banks just giving away money to any and everybody. All you had to do was walk in with the EIN or a social security number and an ID and say, I need money. I want to start a business. I need a loan, whatever. They were giving away money. So a lot of businesses started during that point in time. The market boomed. Why? Because the corporations could do the same thing. The corporations could go not only to other corporations, but to the Fed and to the bank and say, hey, we want to grow and expand. So they would go and get billions of dollars, hire thousands of people for expansion purposes and expand their businesses. Now we know companies like Facebook, there are a couple of others, but that one just comes to mind right now. They kind of like overshot it. Now they're having to consolidate. That's why you hear them talking about layoffs or furloughs or things like that, because they're trying to reassess their staffing structure because now it's a little bit too much. Anyway, now is a good time for them to balance. So anyway, if you think about that from the market perspective, you have um an environment where we could possibly have rates go back down to zero. Look at where rates currently are. And if you have rates go back down to zero, that means we enter another period of pretty much free money. What do you think corporations are going to do? What do you think Elon Musk is going to do with his research and development and Tesla and Starlink and all that stuff? Like that's just more money out there to put into it. So if you think markets are like high now, okay, then think about an environment where not only can banks and corporations go and get money, but individuals can as well. And if corporations and companies are expanding, they can pay more, they can offer more incentives, they give people more money, they give people bonuses. People need somewhere to put that money in the bonuses. Where they put it? Crypto and the stock market. So if I had to just choose between the three US indices that we look at, definitely NASDAQ. It's all pharma and tech. And if you feel like AI and digital currencies and blockchain and just everything digital, everything hands-free is going to be the future, then that's where you should look. S&P 500, because it just covers such a broad range of industries. So you can pretty much get everything you would want out of that. So yeah, I think about it, and to me, I guess it seems like it's a no-brainer, but think about it. Right now, rates are high. The market's still pushing Think about what the markets did after the housing crisis. Even think about what the markets did during COVID, even. Um, when you have think of dropping interest rates as like a stimulus to the economy. If you can think of it that way, then that'll help you to understand why. It's just like writing a check, or it's just like saying, hey, I'm going to give you money, but I'm going to give it to you in like weekly or monthly installments, and they pay it out. And it might not necessarily be paid out in one way. And depending on how you position yourself, you could get money in multiple ways. If you have your own business, if you work for someone, if you trade and invest, if you have a 401k, which I set that aside from trading and investing because that's something you're actively doing. But if you have that sitting on the side passively, that's also doing something for you because you don't even necessarily have to look at that. It's just doing its own thing. Granted, hopefully it's set up the right way. And you're not getting eaten up with fees. But yeah, all those things are going to help you to be in a really good position, especially during that time. So my advice, if I were talking to, um, if I had to have an outer body experience and tell myself what to do, um, and like literally sit and look myself in the eye and be like, look, this is what you got to do. Um, First would be make sure I had money on the side. Um, Always have money on the side. Don't ever have your money all wrapped up into an investment to where if something comes along, you can't participate. So have money on the side and be ready. Know now where you would put your money because when you get ready to put your money towards a certain investment or towards a certain area, you should just be able to do it. Just do it, no hesitation, because you've already thought about it and you have a plan for the money. And then pretty much set it and forget it. Any money that I've invested recently, like I haven't looked at it. There's no point in me looking at it because the things that I've invested, so like I moved hard cash to treasuries and I locked in one of those rates that I told you about earlier. Um, I wanted to lock in a rate that was like 5.4, but I got a rate that was like somewhere between 5.1 and 5.3. Um, anyway, it's like in that range somewhere. Which, I mean, considering if they drop rates, those treasury rates are going to go first, and they're cool. I have that locked in, and I just won't touch it. Um, if you look at what some corporations have done, some corporations have done the same thing. I'll say this, and then I'll be done. Always look at the corporations and what they're doing because the corporations will tell you where you need to put your money and where you need to be looking because they're trying to protect themselves. These are billion-dollar entities that are trying to survive. They're just like human beings, except they have human beings that they're responsible for. So they're trying to survive. Um, so a long time ago, I think I had mentioned that um, there were a lot of companies and a lot of people that were pulling their money out of the US dollar solely because the US dollar to them had become a toxic asset. And the US dollar wasn't worth holding anymore because there were other assets that were better out there in the marketplace. So corporations have done this already. Um, Individuals have done this already. I mean, if you just need one individual in particular that has done this, I mean, you can think about Warren Buffett, Berkshire Hathaway. They've moved billions of dollars out of the US dollar and into treasuries. So that money's just going to be sitting there collecting this interest. So when rates do fall, that money is still collecting the same interest. It's not going anywhere, and you can pinch off of it should you want to. Um, and another cool system, this is really the last thing. If you want to look into treasuries, you can ladder treasuries if you live in North Carolina, not necessarily North Carolina, but if you actually have a bank that offers certificates of deposits or CDs or share term certificates, you can ladder them. So you can pick them from the longest to the shortest or the shortest to the longest duration and open them up. And then you can set it up so that like I think it'll end up being like every year, you'll end up getting like payments and checks and stuff from the bank. But you can do that with treasuries, you can do that with share term certificates. But if you're not sure of where you want to put your money, but you definitely want to lock in a rate, you can do a 4-week treasury and just keep rolling that over until you decide what you want to do. Some people actually do that with their emergency fund. I don't recommend that because if you need your money right then. You can't wait 4 weeks for your treasury to unlock, but you can do 4, 8, 13, 26, 52, 2 year, 3 year, 5, 7, 10, 15, 20, 30 years with the Fed, or not the Fed, but through the Treasury. You can do it on treasurydirect.gov. And if you do it at a bank, you can do 6, 12, 18, 24, 36, 48, and 60 months. And so you can ladder those so that you get paid every month, every 6 months, every year, however often you want to get paid. But it'll just keep rolling over until you say, I don't want my money there anymore, until you decide. So anyway, I'm done. Hopefully that information was helpful.
Absolutely, it absolutely was. Soft thing as always. So yeah, that will conclude the beginning of the week technical and fundamental analysis. As always, I appreciate you guys tuning in, coming out, getting this knowledge and empowering yourselves. Let your family and friends know you love them while they still here, please. And as always, peace and love, everybody. You know.